Hey, everybody, this is Patrick Randall, Bulldog Financial Planning. Thanks for joining me. This is the second video in a series on the One Big Beautiful Bill. In today's video, I'm going to go over a few more updates from the One Big Beautiful Bill, a few changes that provide opportunities for people for tax efficiency, and an explanation on itemized deductions and the difference between those and the standard deduction. So I'll go ahead and get started. Okay, key points from the Big Beautiful Bill. The One Big Beautiful Bill, this was signed into law on July 4th, 2025. The new law serves as an extension or replacement of the Tax Cuts and Jobs Act 2017, which was set to largely expire at the end of 2025. Now, OBBB made several aspects of the TCJA permanent. Many of the added provisions were part of delivering on Trump's campaign promises with specifications and certain limitations. Many versions of the bill were debated, and a lot of these provisions will be subject to revisions in the future, as always. But we also expect to receive guidance on a lot of these, meaning further guidance from the IRS on how to handle each specific item. So the first topic I wanted to touch on today is the no taxes on Social Security. This is a temporary additional senior deduction. It's available for taxpayers 65 or older. Social Security benefits are still considered taxable if combined income is above the thresholds. These thresholds are different than the phase outs I mentioned on the slide, but the idea is that although there is an additional senior deduction, Social Security benefits themselves are still technically considered taxable. However, the amount of the deduction is $6,000 per person, and this is in addition to the standard deduction or the itemized deduction amount that you take on your tax return. Ultimately, these deductions, which could be up to as much as $12,000 for a married couple, will reduce your taxable income. Eligible tax years are going to be 2025 through 2028. After 2028, this is set to expire. We could expect to see some debate on this at that time, and maybe we will see it become permanent. We don't know. For phase outs, there's a 6% rate that's applied for every dollar above the MAGI thresholds. The single MAGI, that's modified adjusted gross income, the definitions of which can be complicated. We can always go over that in more detail in another video, or there are resources available on the IRS website. But if your MAGI as a single person were $75,000 or higher, then for every dollar above that, there's a 6% phase out, and the complete phase out limit is $175,000. For married filing jointly, we see it's $150,000 up to $250,000. So if you exceed the threshold, then you cannot take any deduction. You can see that this could affect taxes for a lot of people, especially those who have income within these ranges. You could see a pretty sizable additional deduction. So in combination with the other provisions, there are a lot of planning opportunities in terms of how to take, how to plan out your income for the year, how this might affect your tax situation, and what your deduction may be. Now, I also promised to go over the differences between the standard deduction versus itemized deduction. And so as a reminder, we see the higher standard deductions remain. So before the TCJA, standard deductions were lower. Therefore, we saw more people itemize. After the introduction of a higher standard deduction, that actually created more tax savings for most people because, not everybody has enough itemized deductions. And I'll explain that more so, because ultimately what you're doing is when you compare your itemized deductions, you want to total those up And if those are higher than the standard deduction, then you'd want to use the itemized deduction. Um, so we see that for 2025, the standard. So with that being said, you have a $31,500 uh, standard deduction. Now we can look at common itemized deductions that would have to equal an amount above that in order for it to make sense that you'd itemize. So common things like certain medical and dental expenses, and there are a lot of details with that you'd want to be careful, because there is a threshold 7.5%, as well as certain expenses may or may not be eligible, especially if you're getting reimbursed for those. Other things like state and local taxes, the SALT taxes, that's something that you also want to be careful about, but also is a common itemized deduction. Other things like interest you pay, home mortgage interest is deductible up to, with certain limitations as well. The next things from the One Big Beautiful Bill are additional itemized deductions. First of which, mention that SALT deduction, state and local taxes. There's a temporary increase. So the bill temporarily increases the itemized deduction available for state and local taxes from $10,000, where it used to be. That's where it used to be, was $10,000. Now it'll be $40,000, and married filing separately would be $20,000. The deduction starts in 2025. It's eligible for tax years 2025 through 2029 with a fixed 1% increase per year. So that's similar to a cost of living increase, where every year you see that increase. This goes up 1% a year, and in 2030, the amount does revert back to $10,000 unless this is made permanent or some other provision gets put into place. There are phase outs. The phase outs are much higher than for the senior deduction. For the SALT deduction, which is an itemized deduction, this begins at $500,000 for modified adjusted gross income and is gradually reduced back to $10,000 when you exceed $600,000. Next is the charitable giving. So for those who use the standard deduction, the One Big Beautiful Bill created a permanent charitable deduction, and that starts in 2026 with limits of $1,000 for single filers and $2,000 for joint filers. This is different because before this provision, you would have had to have itemized in order to take advantage of a charitable donation. So there's still an incentive to make charitable donations for people if they're using the standard deduction. There's no 0.5% floor for the deduction, which is different than those who itemize. And you're not eligible to donate to donor-advised funds for this or a private non-operating foundation. So a lot of times, if you're using one of those charitable donation funds where you can make investments in the fund through a broker-dealer, this wouldn't qualify for that. The charitable giving changes for those who itemize. You're seeing the 0.5% floor of AGI, which means a taxpayer with $100,000 in AGI, which is different than the modified adjusted gross income. That's another tax topic that can get detailed. So AGI is the floor, is the income level used for the floor, and that's 0.5% of your AGI. So if you end up having an AGI higher than $100,000, then you must donate more than $500 for this to count towards a deduction. The tax benefit of deductible contributions is capped at 35%. So what that means is taxpayers in the 37% tax bracket who have deductible donations of $1,000 can deduct $350 rather than $370. The deductible portion is still calculated using the same 0.5% floor. as well. So some pretty, I mean, I would say these aren't huge changes, but I think for a lot of people, in combination with your other deductions, especially if you're using the standard one, you can still take advantage of deducting more because you're charitably inclined, which is something that is nice. So that can be pretty nice. Next thing is for new home buyers or people buying homes. If you ever heard of the phrase PMI, mortgage insurance premiums, this is for anybody who typically, if you put less than 20% down in your home, the mortgage bank is going to want to have a form of insurance that protects the mortgage in case of something happening where you wouldn't be able to pay for the property. This means that, as I mentioned on the Schedule A, you do see that mortgage interest in general is typically deductible with certain limitations in terms of how to calculate that deduction. But you'll get a tax form that essentially gives you the amount of your mortgage interest every year. So you would be familiar with that, and you'd take that and apply that with your other itemized deductions. What this does is it means that you can include your PMI payments throughout the year with those. So ultimately, what ends up happening with this decision on whether you're going to itemize or take the standard deduction, it means that you're going to be combining, the deductible mortgage interest, your state and local taxes, unreimbursed medical expenses above 7.5% of your AGI, any other itemized deductions, and you can also lump in your PMI. Lastly, one of the big ones here from the One Big Beautiful Bill is the new provision for new vehicle purchase interest. There's a temporary deduction for people purchasing new vehicles. Now, there are stipulations with this, like all other parts of the tax code, pretty much. But people who purchase qualified passenger vehicles, will get a loan interest deduction. So this could be for a car, minivan, van, SUV, pickup truck, or motorcycle with a gross vehicle weight rating of less than 14,000 pounds and that has undergone final assembly in the U.S. There are other limitations, and we're expecting further guidance. We don't see this deduction being listed necessarily. We're going to have to wait to hear from the IRS on how they want people to handle it, especially for cars purchased this year. The deduction amount is up to $10,000 in qualified interest, regardless of filing status, and is available whether you itemize or use the standard deduction. So for this one, this is another pretty big one. If you end up deciding that you want to finance a vehicle, granted you have to spend the money on the interest to be able to deduct it, but if that's what you were planning on doing, could be an opportunity to have some tax efficiency there because you can increase your overall deductions whether you itemize or use the standard deduction. Another caveat is the vehicle has to be for personal use, not business or commercial, and lease payments don't count. This is another temporary one for tax years 2025 through 2028, and after 2028, this is set to expire. There are phase outs. You can see that modified adjusted gross income greater than or equal to 100,000, and for modified adjusted gross income for married people of 200,000. So this won't work for everybody. Some people won't be able to take the deduction, and we'll get more guidance on it, but it is something that is worth looking into anyways. And so that raises a good point. How does tax planning help, and what is the role of a CFP professional in all of this? So me, I'm a CFP practitioner, and I own an RIA, Bulldog Financial Planning LLC. My part in all of this is I help identify opportunities to be tax efficient, and ultimately the goal of that is to help my clients maximize tax savings as much as possible, but also, give them, you know, uh, financial projections and help coordinate and guide, the tax planning process by modeling the tax impact of financial decisions and integrating tax strategies with a client's broader financial goals as part of their comprehensive plan, including investments. Um, Now, while CFP practitioners do not prepare tax returns unless separately qualified, they do work collaboratively with tax professionals to help clients make informed, tax aware decisions throughout the year, not just at tax filing time. So that's one, added value of working with a financial planner like myself is we'll work with you throughout the year. Look for, I have a list of different financial planning, tax planning topics for people to go over with me. I also utilize technology and financial planning software to help illustrate these things during our meetings. Could be anything as even going over your past tax returns, looking at current finances, looking at whether you're eligible for some of these credits or deductions. Do you think you should itemize based on your different expenses? Or do you think the standard deduction is going to work better? What kind of gifting strategy do you have? And is that tax efficient? A lot of times people don't realize using a qualified charitable distribution uh, instead of taking their RMD directly to themselves, that could help them with some tax savings there. How about planning out your Roth conversions or, taking distributions as part of an inheritance? These are all considerations that go into the tax planning process. Other things like harvesting annual capital losses or looking at capital gains and what kind of tax rate you might have. All these things go into your comprehensive financial plan that also accounts for other aspects of your overall financial planning picture, which includes retirement and other aspects like planning out your Social Security, anticipating, or planning around healthcare expenses, other major expenses like home purchases, retirement moving, those kind of things. So there is a lot of value to doing tax planning. And as you can see, from this video and past videos, the One Big Beautiful Bill does present a lot of tax planning opportunities. In particular, you can see that with all these different moving parts, you've got from the first video that I made, I go over the no taxes on tips, no taxes on overtime, and the limitations on those. But in addition, you can see that when you consider how much people could save from tax planning and looking at these things and all these different provisions, there could be a lot of opportunity for people. And either way, it doesn't hurt to see if you would be eligible. So always something that is a value add whenever you're working on your financial plans. So thanks for tuning in. I appreciate it. I will be doing another one. There's a number of different topics, and always stuff to in terms of the one. And here are the sources cited.